Hi, this is Todd Baker, your certified mortgage planner. Today we're going to talk about just conventional loans, and I'm doing this so that you can understand what a conventional loan is. So first, by definition, a conventional loan is a loan that is neither guaranteed nor insured by the federal government. And there's two corporations that securitize and sell conventional loans, and those are Fannie Mae and Freddie Mac. And they each have guidelines that are almost identical. And what we do as a mortgage banker, in fact what all mortgage bankers do, is we underwrite under their guidelines, we fund the loans, and then they get sold off through Fannie Mae or Freddie Mac. So what we're going to talk about here is some of the basics to understand what goes into a conventional loan. So the first thing is the maximum loan amount is $417,000. The next thing is the minimum credit score is 620. However, 680 score is typically where we want to be to do a conventional loan if you're putting less than 20% down. I'm going to go over in detail why. 45% is the debt ratio, and let me tell you the basic fundamentals how debt ratio works. Basically what happens is we take your gross qualifying income and then we divide that by your total housing payment that includes taxes, insurance, so basically principal, interest, taxes, and insurance, and that ratio is called your housing ratio. Then what we do is we have to add in revolving debt, auto loans, any student loans, and then between those monthly payments and the housing expense, that's your total debt ratio. Conventional is capped at 45%. So there are cases where you might have a big down payment and you might have really good credit, but because of the situation, the debt ratio might be too high. You might want to go FHA actually in that situation. There are occasions in which you can go over 45%. The way all lending works, and conventional loans work as well, is that once we've taken your loan application, we've ran credit, we've verified all of the data inputs into the system in terms of income and assets and whatnot, we run it through what's called an automated underwriting system, and it'll give us either an approval or or a refer finding, meaning it either it approves or it doesn't approve it, and based on your credit and the inputs. And if that system, if you put 20% down and have lots of money saved in reserve, it sometimes will let you go up to 49.9%. So there are times there's a little bit higher ratio. You can go as little as 3% down with conventional, but in a moment I'm going to show you two things: more private mortgage insurance, how that works, and also loan level price adjustments, and why that sometimes the 3% down isn't always the best way to go. Another huge advantage is in Texas, because we're a community property state, if we go conventional, we can actually exclude non-purchasing spouse debt. So that's a big advantage. You do have private mortgage insurance if the loan to value is over 80%. So another way of saying that, if you put down less than 20%, there's going to be a PMI. And then like I said, 680 credit score above, really more germane to conventional financing. So I want to show you two things. First, loan level price adjustments. So both Fannie Mae and Freddie Mac, and this is real important to know, Fannie Mae and Freddie Mac both have, in fact, let me just erase this so you guys can see real quick, a little better right here. All right, so Fannie Mae and Freddie Mac have, you can see the loan level price adjustments are based on score. So if your score is over 740, you get prime pricing. If you get 720 to 739, based on the loan to value, there's certain adjustments, and you can see these percentages. And what that means to you as a consumer, it means a higher interest rate. Everyone that does a Fannie Mae or Freddie Mac loan has the same overlay, and you can see if you go to 620 to 639 and you're putting only 5% down, these are huge adjustments that hit your interest rate, so you end up with a way higher interest rate. So what goes into scoring are about typically over 25 different factors, but the top three are loan to value, and credit score, and occupancy type. Okay, now when it comes to private mortgage insurance, or what's known as PMI, I just wanted to show you a rate sheet from Essen to give you a quick idea of how it works. So mortgage insurance, if you put less than the 20% down, there's two basic rules you want to know. Number one, it stays in effect until you pay the house down to 78% of what you purchased it at, and then it goes away automatically. Well, if we do a 97% loan to value, which is 3% down, or we do a 5% down, 5% down takes 11 years, 10% takes about 6.5, 7, 15% down only takes about 48 months. So if you put a little bit bigger down payment, you're going to have MI for a shorter period of time. There's also a way to petition to have it removed, and I teach my clients how to do that if we end up doing a conventional loan together. But notice it also has 760, you get the best rate. So at 760, the MI factor is 0.41%. If your credit score goes from 740 to 759, it goes up to 5.59. 720 to 739, it goes to 0.73. 700 to 719, it goes to 0.75. Here's where it goes 780 to 699, it's 0.94. But below 680, it jumps up to 1.21. Well, at that point, typically, you want to look at maybe doing an FHA loan, because you're going to have a lower cost situation between what I just showed you with the loan level price adjustments and these monthly mortgage insurance rates. So that's sort of some insider baseball on how it works. And I hope you find this helpful. I will, of course, walk you through with the total cost analysis and make a recommendation based on your specific credit profile and your specific 5 to 10 year financial plan on what works for you. Thanks so much and have a great day.